Hello to the Econ Buff podcast. I'm your host, Lee Stitzel. With me today is Dr. Ryan Mattson, professor of economics at West Texas A&M University. Ryan, welcome.
Hello, thanks for having me again, Lee.
So this is actually part two of a two-part episode here with Ryan. We're going to talk about the macroeconomics of coronavirus. So if you haven't listened to part one, I encourage you strongly to go back and check that out. That's in its usual place on YouTube. You can find that under the title Macroeconomics of COVID-19. We're going to put this one up as the monetary policy response to COVID-19. So Ryan, our topic for this episode is the monetary policy response to this pandemic. So I want to start out with a couple of things. First, what has the Fed done and what is the Fed doing in response? And then what's the point of the Fed enacting this monetary stimulus for this pandemic?
Sure. So before we get into the pandemic, I do want to cover a little bit of the kind of prehistory to this, because the Fed and several macroeconomists were seeing a contraction or slowdown happening in 2020 anyway. So by the time we hit quarter four of 2019, quarter one of 2020, the Federal Reserve was already beginning to play with the overnight repurchase markets in the shadow banking system. They saw a coming contraction as it was, either from the yield spread or from other indicators they were using, and they began injecting liquidity into the shadow banking system. As early as December of 2019 into January and February, before the COVID-19 outbreak really gained steam, came to Europe and the U.S., et cetera, and began its own recessionary pressures. So kind of to give you an idea of that, you had the Fed meeting as regular in January. January 28th, and they go through and they do their regular, okay, we're going to hold interest rates fairly steady. We're not going to do much. We're going to wait and see what happens. And then around March 3rd, they come out with an unscheduled announcement, which hasn't really happened since 2008. So that gives you some idea of the gravity of the situation that the Fed was looking at. And on March 3rd, they dropped interest rates about 50 basis points, or about 0.5%. And this was it was unexpected. It was I guess kind of a nice shock in that sense. Okay, dropping interest rates, injecting liquidity, and they'll be doing that through their typical open market operations of pushing cash and reserves into the system and pulling treasury bills out of the system. That's just the regular monetary stimulus that they do, along with what they've already been doing in terms of the shadow banking system of using repurchase agreements to inject liquidity. And then they have another unscheduled meeting just before the regularly scheduled meeting. Regularly scheduled was March 17th to the 18th. They canceled that meeting, held it on the 15th, where they announced that they'll be dropping interest rates down to zero, or 0 to 0.25%. So some very extreme measures being taken by the Federal Reserve in response to what they see as a coming contraction due to COVID-19, due to quarantine, social distancing, all those measures that, of course, need to be taken to resolve a public health crisis, but that, as we discussed in the previous podcast, would have contractionary effects on the U.S. economy.
So we set this up in the previous episode a little bit, and you mentioned it again here, those excess reserves. So I'm interested because I think we mentioned it briefly, and I'm happy for you to talk about it again now. Tell us a little bit about the banking response to the liquidity that the Fed tried to put into the market after the 2008 crisis, how they responded, and we got those excess reserves. What's the state of that now, and how do you think that'll affect the potential transmission mechanism from the Federal Reserve's actions to the real economy this time around?
Right. So in 2007, 2008, what we ended up with was a large amount of quantitative easing, about $2.5 trillion worth of quantitative easing going into the economy. Now, the usual metaphor is that Ben Bernanke or Janet Yellen is throwing money out of a helicopter, and the money is created and goes to the banks and the households and everything. That's not quite how it works. The transmission mechanism is dependent on the Federal Reserve creating creating this money through the primary credit dealers. So these large financial institutions get this money in order to lend out to other smaller banks or mid-sized banks or other firms and engage in the macroeconomic transactions that we'd like to see that would expand GDP growth. So in 2007, 2008, the problem is first of all, we lost two of those primary credit dealers, Lehman Brothers and Bear Stearns. So that became a bit of a problem in terms of processing the liquidity from the Federal Reserve into the economy. On top of that, the other primary credit dealers became, I would say, very risk averse in what they put out. And even then, when they did put out their lending to smaller banks or their lending to firms and corporations, these banks and firms and corporations were also very risk averse. So this led to, instead of, say, banks keeping a small amount of excess reserves, because they're losing money when they keep excess reserves, they're not earning any interest rate on it. It's better if they loan it out, even at a small interest rate. But we go from, near zero excess reserves held above and beyond the required reserve that the Federal Reserve wants everyone to hold. I don't know how many times I can say reserve in the same sentence here, but we went from about near zero to 2.5 trillion of excess reserves held back from lending. That could be 2.5 trillion that could be going to expanding the U.S. economy. Now, thankfully, we've gotten that down to about 1.5 trillion in the past 10 years since excess reserves first exploded in 2008. But there's an interesting story behind that as well, because what the Fed started doing in 2008 was allowing but providing interest for these excess reserves held by banks. So if the Fed then creates this money, pushes it through the transmission mechanism to the primary dealers, if they don't lend it out, they can earn, say, 0.25%, 0.4%, 0.8%, some small amount. And this seems like a contractionary measure the Federal Reserve is doing in the middle of the 2008 crisis. But the idea was that in the long run, if we ever face a large crisis like this again, that the Federal Reserve can incentivize lending by lowering this excess reserve interest not only down to zero, but potentially below zero, and charge negative interest rates on these excess reserves in order to incentivize banks to lend. When previously, before 2008, there was just no interest rate on these excess reserves at all. So it's an interesting new tool that the Federal Reserve has created for itself in the past 10 years that I think may come into play in the next few months.
So I'm very interested in that. If you had been talking to me, and of course you have, but the third person you had been talking to me before this, you would know that I've been somewhat critical about the pace at which we've raised interest rates, because I've been advocating for, we're in this expansion, we know that a recession is coming, let's give ourselves a little bit more ammo on the monetary policy front. And so when I say interest rates, in that case, I mean, the interest rates that we're accustomed to the Fed targeting. So you're telling me and us as listeners that the Fed has this other tool in its bag, which it realized, and I think there's almost a credit to them. We can talk about whether we think this is a good idea or not, but we're always concerned about being at the zero lower bound and engaging in what traditionally would have been considered unconventional monetary policy. We're sort of beyond that now. That is starting to become just our default every time we get to a serious situation. You're saying, well, the Fed realized, well, they got these excess reserves, and so our normal transmission mechanism of putting money to the banks and then the banks turn around and lend that out breaks down sometimes. And so we're going to add this sort of second tool, this, I don't know exactly what you'd call it, but second mechanism, which allows us to put pressure on the banks to not hold those excess reserves. So whereas what you said a minute ago was, they can hold their reserves with the Fed, and then they would have gotten positive interest rates, which means in order to want to lend that out, they would need to have some kind of return higher than that positive interest rate.
Yes.
Now the Fed can say, well, let's charge a negative interest rate to them. And then now, in order for that money to be lent out to the public, the it only has to be over this negative amount instead of that positive amount. So even zero would be a win for them in that situation. They could sort of have this second mechanism in the transmission mechanism. Is that a good summary of that? Was there anything you would add to that?
Yeah, I mean, it's all it's all part of the toolbox the Federal Reserve is using. They've come up with a lot of very creative ways to enact monetary policy, really all just to shift this aggregate demand curve. If we go into a recession and aggregate demand begins to contract, the Federal Reserve has to find some way to push that back out. So during a financial, say, a financial crisis caused by mortgage-backed securities, or a housing crisis, then you make lending easily available and hopefully demand responds to it. You have a terrorist attack on September 11th. People are, understandably scared and not sure what to do and hunkering down. And, well, you provide liquidity so that employers don't lay off their workers, so that they don't, so we all don't, kind of, social distance and basically headquarters at home for a while and don't spend and don't make any economic transactions. You make that easier for them to do, and you expand aggregate demand. What's a little different this time is now, those types of tools are really only useful if there is demand for that lending, demand for that borrowing and demand for that lending. And right now, what we have, and yes, rightfully so. Again, I don't want to encourage any of the listeners to go out and spend. Please don't. Stay home, flatten the curve, be healthy. But that kind of behavior is really part of what's making this recession so much worse. And why, with what the Fed is doing, is really only going to kick in until after this public health crisis is done, when people are able to go out and start businesses, borrow money, buy houses, buy cars, buy dishwashers, and that sort of activity. But it's all part of the different tools that they use and what they're trying new things to see what works. I saw a joke on Facebook I can't remember who it was now, but he's I think it might have been Arthur Lubel, who's an econometrician at Boston College, but he posted on Facebook that that scene in the movie where the cowboy runs out of ammo as he's shooting and then he throws the gun. That's sort of where the Federal Reserve is right now. we're going to see what works.
I'm really glad you brought that analogy up. So essentially, what spurred this was you reached out to me and said, I'd like to talk about the monetary policy response. And so you said, well, here's some things we could potentially talk about in this setting. And meanwhile, I, through my own reading, and I'm going to steal some of the ideas from some economists here momentarily, was encouraged and really wanted to ask you some questions. And your cowboy running out of bullets and throwing the gun, that's actually exactly the analogy that I have used, right? Is I was critical of the Fed lowering right to zero because I felt like you'd used up all your bullets and we weren't that far along. Now, maybe history will vindicate the Federal Reserve for moving quickly, and this is moving a little faster maybe than I thought, and I think a lot of people thought that it might. That's the power of exponential growth, right? And that's the problem with this potential or this pandemic. But this is why I love doing this podcast, right? Because I've learned something here that I didn't know before this conversation that we're having about the idea that we could flip interest rates negative on interest paid on reserves at the Fed. That's pretty important, and I think my intuition, correct me if I'm wrong here, is that uh, if that's analogous to throwing the gun, that is surprisingly effective, would be my guess. I guess we'll see see what the test of time tells us. But I'll be surprised if that isn't effective.
We'll have to wait and see. It really is interesting from a historical perspective that someone thought of this in 2007, 2008. it's been tried before. I want to say that Switzerland and Japan have experimented with this as well as the European Central Bank has been experimenting with this. But we spent the last 10 years getting banks used to positive returns on these reserves, and for me growing up, the idea of holding on to excess reserves just seems crazy. Why would a bank do that? You're losing out on what you could be lending. But it could very well be that, okay, if we have to do, so we've got the Fed funds rate at 0, and that's the 0 lower bound. We can't go lower than that, at least so far. I could be wrong on that. But one way to indirectly influence that is also then, once you control these rates on the excess reserves, then drop those below 0 and incentivize the bank and say, look, yeah, you may get really little on your lending rate, but that's still going to be better than the penalty you're going to be paying for excess reserves. And that is, I think this is the crisis where they may test that. So far as I know, they haven't yet. They've mainly been experimenting with buying corporate bonds. People have been talking about the Fed maybe buying actually, I think they have started buying exchange-traded funds, or the Fed actually going in and directly buying and selling stock. I'm not entirely certain whether that is within their power to do, the buying stock. The corporate bonds, yes, from what I understand, yes, they can. For stock, that's something that I'm not sure they actually can do that. But Bank of Japan has started doing that. About 2 weeks ago, they began buying stock on their market in order to inject more liquidity, despite the fact that they're at, in terms of their overnight rates at 0, and then I think in terms of their interest on excess reserves at negative levels. So, what's going on is it's not unheard of, and it certainly is within the academic literature, but it has not quite been tried, especially in a crisis situation like this, at least not in the United States. A lot of people, when they hear negative interest rates, they seem to think that, I'm going to deposit $100 in my bank account and it'll give me negative 2%, so why not just hold cash? Which, yes, exactly right. When you start getting negative interest rates from your bank, hold cash. But that negative interest rate on excess reserves may not bleed into our deposit rates as mere mortals anyway. We won't get very good deposit rates, but we may not get negative. But it's an interesting mechanism, and it's dealing with this problem of these excess reserves that have accumulated over the past 10 years. How do we fix this transmission mechanism and get that liquidity out there? So the other aspect of it that I do want to get into also is what they've been doing in the shadow banking system in terms of they've already been buying and selling repurchase agreements or enacting and closing on repurchase agreements, which is a very complex market, and but it all boils down to pushing more liquidity into certain firms, into certain financial markets. When 2008, 2009 happened, and the Fed is looking at their monetary aggregates M1 and M2, and they're looking at their interest rates. Interest rates go to 0. Yay, we did our job. Monetary aggregates are expanding. Yay, we did our job. But then there's this explosion in the monetary base that Art Laffer pointed out in June of 2009 should lead to this explosion in inflation, and it didn't. And the problem is that monetary base M1 and M2, these are far too narrow of measures to capture what's going on with our monetary service. So if you go to a measure like Center for Financial Stability's Divisia aggregate, these Divisia M4, Divisia M3 aggregates that were developed by Bill Barnett at the Center for Financial Stability, you see this huge contraction in 2009. That is almost entirely from the shadow banking system, the drying up of commercial paper being issued by corporations, money market mutual funds crashing, repurchase agreements crashing. And that is something that the Fed has been worried about since actually December before COVID-19. And especially with New York City getting hit so hard, I think that in the next few weeks, we'll have the same issue of the shadow banking system, the unregulated financial markets in the US crashing again. And that's where the Fed is really starting to consider, okay, do we start buying corporate bonds or selling corporate bonds? Do we start buying stock? Not just to shore up stability overall in, say, oh, I want the S&P 500 to go back up, but to provide liquidity, because when the S&P 500 crashes and we lose like $3 to $5 trillion in equities, that's 3 to 5 trillion lost in speculative or store of value services in people's retirement portfolios. So the Fed wants to recognizes that this is also a form of liquidity. This is some kind of, for lack of a better term, monetary service, right? You got a medium of exchange, unit of accounts, store of value, and then this kind of speculative service that's also there. So we've lost a huge amount of liquidity with the stock market crash, and we're losing a huge amount of liquidity in the shadow banking system. So the Fed needs to find ways to shore that up, because it can't just be a traditional, we're going to lower rates so banks can lend more, because that won't expand it enough. And to see that, we need to take a look at those Divisia M4 measures that take a more broad look at monetary service. Yeah.
So two questions then. The first is, obviously the Fed was aware of the shadow banking sector, but now they seem quite a bit more invested potentially in intervening in those areas. So the first thing I want to clarify is the things, your traditional monetary policy actions and your traditional is not the word, but your recent mechanisms that we've added when we get to zero lower bound, including interest on excess reserves, those don't affect shadow banking. So that's why they're targeting potentially corporate bonds.
There's
or even
less
stocks.
effect of the classical traditional open market operations in that shadow banking system. And then also, since it's unregulated, we also don't really even know what's going on. I mean, it's called the shadow banking system not because there's some dude on a Skull Island who's twisting his mustache and thinking of evil plots. It's a shadow because we don't observe it directly. We observe the shadow that's cast from it. And much like, hey, at noon I have a very small shadow, because the sun's directly overhead, but maybe at 3 p.m. it looks much longer. So we have a very vague understanding of how large this market is and what's going on in it. We have some measures which are nice, but we kind of have to go with at least the few things that we know.
So let's turn to the Divisia monetary aggregates. I want to ask two questions. The first question is, does the Fed actually use them? It's my understanding that there are central banks that use them. So can you talk about which central banks around the world might actually use those, and if the Federal Reserve of the United States does?
Sure. The Bank of England uses Divisia monetary aggregates. The Bank of Japan has the data and has access to them. I don't believe they provide them, though. The Bank of Israel was using them through the crisis, the 2008 crisis, I should say. I don't think that they use them anymore, and the Bank of Poland also uses them. The United States, the Federal Reserve used to provide the Monetary Services Index, which was a very nice measure up to the M2 level, which they froze in 2005 and then discontinued, I think, sometime around 2011, 2012. The Center for Financial Stability takes the interest rate data that we get from Federal Reserve and other sources, and we construct that and provide that on a website so that people can see it. And so, if you go to the website, you can see the crash and the broad measures. The idea of these measures that differentiates them from the simple sum, right? We all know M1, you add up currency, checking accounts, and then M2, currency, checking accounts, savings accounts, money market mutual funds. Well, savings accounts and money market mutual funds have interest rates. Currency doesn't. So you weight the growth by this interest rate price, not the interest rate itself, what's called a user cost. Once you derive that user cost price, you find the expenditure value on, say, savings versus currency. You weight it and you add it together into what's called a Divisia index number, which is, as I said before, you weight by growth. You weight by the expenditure growth. And this is, mathematically speaking, the proper way to do it. And we've known that since Divisia was around in the 1910s, 1920s. Irving Fisher even said the simple sum is quite possibly the worst measure you can use, yet we still hold on to it. So, and this is where the crises are interesting, because you see where the simple sum gets it wrong. And then you can see where the Divisia measure can get it right. So what, at least looking at the recent measures, the Divisia M4, the broadest possible aggregate that we measure, has had in the past 2 months, had a recent uptick in growth. And that's a reflection of the Federal Reserve jumping into the repurchase agreement markets, the repo markets, and attempting to provide liquidity in the shadow banking system. So in January and February, you see Divisia M4 spike up a bit more than it does, go from, say, 3 to 4% to 5 to 6%. This happened before in 2007 as the financial crisis was unfolding. So we're probably going to see a spike in the broadest possible monetary measures as the Fed attempts to shore up liquidity. But the Fed is not the only one creating liquidity. And that's the reason we want the banking system to work and the shadow banking system to work is they create inside money. You remember from high school or maybe even Principles Macro, they talk about you deposit $100 and then the bank lends out 99 of that, and then that person deposits that 99. So your $100 deposit actually ends up being something like 1,000, or depending on the multiplier, 1,000 or 10,000. If that multiplier breaks down, then your deposits just stay there. This is kind of akin to the fiscal stimulus multiplier. I get $1,000 check, I go out and spend it, and that becomes someone else's income, and then they spend it. So we want these banks, through their transmission mechanism here, to expand this monetary stimulus. But I think what we're going to see as the shadow banking system contracts, and as we respond to that destruction of wealth and value and liquidity in the stock market that we saw in March, we're going to see a contraction in the money measures as we see this contraction in GDP. The liquidity is drying up, or the liquidity is freezing, however you want to put it, but the plumbing's going to stop working.
So there's two brief comments that I want to make. The first is in regards to how you calculate Divisia versus simple sum, and you laid that out very well. It is fairly technical, so it's hard to know how well the listeners are going to be able to follow along there. But I think the intuition there is that when you have prices in that situation, you can then account for the opportunity cost of holding money in different places. Would you add anything to that intuition, or is that sufficient?
I think that's sufficient. But if anyone is curious, you can look at Barnett's work. He's got a paper in Economics Letters in 1979 that deals very nicely with how to calculate the user cost. You also have recent papers on Divisia that are provided by the Center for Financial Stability, and those I think are also great resources on it. Mainly, it's what you're giving up in order to hold that deposit. I have a savings account, but I could have that money in a 10-year Treasury bond instead. So I'm foregoing that higher interest rate.
Right, which is exactly what I meant by opportunity cost. So plug the give us the Center for Financial Stability website. Plug that a little bit. So if our listeners want to do a little reading of their own,
sure.
Some stuff that's accessible.
You can go to the. Oh, I should have had this up and ready so I could say it. But basically, if you Google the Center for Financial Stability, it should come up. But let me go ahead and pull up that website there, because there are two very. There's my browsers. Center for Financial Stability is run by Lawrence Goodman in New York City. It has several different projects going on, all of them great. They had a history of the Bretton Woods Conference, for example. My web browser's not working. So I would say Google Center for Financial Stability and then the Advances in Monetary and Financial Measurement project. And you'll find the US data all the way back to 1967, as well as links to various papers in the library. It's
Yeah, I apologize for putting you on the spot there. The next thing that I wanted to turn to before we kind of move to the second half of the podcast here of this episode is one of my pet topics when I teach monetary policy is to talk about the lag. And I always start with the lags that have to do with measurement. And so, one of the things is things are happening now, but we don't observe them immediately because it takes time to collect data, to compile it, to aggregate it, to understand it. Talk really briefly about that. Like, what's the length of the lag? So, things that are happening now,
Mhm.
when are we going to see this reflected in all the different aggregates? And are there different speeds
Yeah.
between the simple sum and
Um,
divisia?
I think we'll tend to see a lag difference between, say, the Fed's actions, much as it was with quantitative easing in 2008. We'll see this kind of expansion in the money supply and then the contraction as aggregate demand continues to be pulled down. Uh, the longer we're in social distancing and quarantine, and as we should be again, please listen to the CDC. But the longer we're in this, then the longer GDP will be contracting, and the longer monetary supply will be contracting as well, because banks will not be generating this inside money. Um, so, in terms of the lag, with GDP data, it's a quarter. You really don't know what's going on until 3 months later. With the monetary aggregate data, it's a little faster. It's a month. You can see things happening much more quickly, and keep in mind I'm a macroeconomist, so according to me, in the long run, we're all dead. So the short run can be anything between a quarter and 20 years.
Right.
So the interest rate data is usually the fastest on what you can see, and this is one of the reasons I like to kind of rely on the spread, because I consider the spread to be a form of user cost. But you can get the 10-year and 3-month treasury data, for example, on a daily basis, and that gives you some idea of the opportunity cost of, say, holding a short-term bond versus a long-term bond. And if that crunches down to zero or goes negative, then that bad stuff may be happening. So it's hard to keep track of these things, and it's it's important to keep a nice variety of what you're looking at. But for me anyway, as a monetary economist, I really appreciate the work done by Bill Barnett and the CFS in creating the divisia aggregates, because it's a bit more timely than the GDP data, and it's a good reflection of what's going on, at least on the monetary side of our economy, and gives us some good intuition, a good way to interpret what the Fed is doing, and what the banks are doing as well.
So I want to turn now to a theme, and the theme is going to be, is the Fed really out of ammo? What else can it do? Are we down to throwing the gun, or do we have more bullets left? And these are questions that I'm going to bring to you based on the work of an economist named Scott Sumner, and I encourage people to check out his work at Econ Lib. And so the first thing that I'm going to ask you, because let me set it up very briefly. So Sumner basically says we have spent all of our fiscal policy bullets. You and I are here to talk monetary policy, so I'm going to kind of keep us on track in that regard. But the idea is that when we go and deficit fund things and use government spending to try to increase aggregate demand, that's fiscal policy. And in Sumner's opinion, which I'm sure many economists would disagree with, I think I saw a piece by Paul Krugman in passing that was encouraging deficit spending, that there's much less room in that area than there is in terms of what the monetary policy can do, what the Fed can do using monetary policy. So I'm going to bring these up in sequence. The first one that I want to ask you is, um, Sumner says one very powerful thing that the Fed could do is to target the price level. So do two things for us. What would it mean for the Fed to target price levels, and what do they target now? And discuss that interplay there.
You mean, is Sumner talking about targeting the price level or targeting the output level?
I don't have it in front of me, and I thought he had said
Oh, okay.
price level.
So,
If
yeah.
you're prepared to
So,
talk about output level, we can go that
I can do,
route, and
yeah,
then
we
I
can
can
go either
make an
one.
amendment later.
So, yeah, the reason I say that is Sumner's always a big proponent of what's called nominal GDP targeting. You
Sure.
target a certain growth level of your nominal output. And what the Fed is doing right now, it states it's doing short-term interest rate targeting, but that's what's called an intermediate target. The Federal Reserve is the actual target is to target the price level, to target a 2% inflation rate. Something magical about 2. That's just, I guess, the number that we all chose, and our Bank of New Zealand started with, so that's the one we want to go for. We've agreed is a good number. So targeting stably that inflation rate allows people to make and enforce contracts. It keeps economic transactions very boring, which is very good. Everyone knows there's going to be a 2% inflation rate, and that will affect the prices this far out, that far out, that far out. You can do cost of living adjustments for things like Social Security checks, or you can do what's it called? I think it is even called a cost of living wage adjustment for if you're working for a firm. They can say, well, 2% is a base raise that will give you do better, we'll give you more, that kind of thing. So this allows for a lot of stability. If there's a shock, like a 40% inflation rate, then contracts go out the door, and you can't, really purchase as much with your money as you could before. But in the same way, also, if you've got a 40% disinflation rate, that kind of goes on the other end of things. It's just as bad of a shock because, again, the contracts are kind of going out the door on the other end. The firm may be overpaying the worker in that sense. So what you want any central bank that controls the money supply to do is create a stable inflation rate, and that's the price level targeting. Now, Scott Sumner, and I guess this is where my confusion comes in, but let me just go ahead and cover this too. What Scott Sumner then says is, well, what we should do is pick an output level. We want GDP to grow at 3% every year stably. Now, one component of that is the inflation rate. The other component of that is the real output growth, which the Federal Reserve can't do anything about. The real output growth is determined by technology, population, resources, physical capital, human capital, labor. The Federal Reserve can't affect any of that. But in the long run, they can't affect any of that. What they can do is they can play with the price level and the inflation rate so that they can reach a certain point. Now, what Sumner then kind of takes the step forward and says, well, do whatever you don't say 2%, because maybe you have a 2% inflation growth and then a negative 3% GDP growth, and that's still a contraction. Then what you'd want is, if you're trying to maintain 2 to 3% GDP growth, you'd want a higher inflation rate, so it makes it a little more dynamic. And that's something that the Fed could do. They can play with their inflation target in a dynamic way that is targeting gross domestic product, which is this very important measure to macroeconomists and really to us all. So that's one way. And
So
I think I'm forgetting if you had another question.
no, so I pulled up Sumner's piece here. It's the piece, "There's Never Been a Worse Time for Fiscal Stimulus." It's on econlib.com. I'll put a link up to it whenever we get this to the website. And that's the Econ buff at wixsite.com. So I'm going to read this off to you, and then you interpret it for us, and then see if you want to change the response. I think you're right and I'm wrong, but I'll read it here. So, quoting Sumner, "Instead of blindly throwing money at the problem, we need a smart response to the coronavirus epidemic. It would contain the following components. First, an immediate shift by the Fed to level targeting, combined with a commitment by the Fed to buy whatever it takes of any asset necessary to quickly return to its price level or nominal GDP target path after the immediate crisis is over." End quote. So I think that pretty clearly reads that you were right, and I
Yeah.
maybe
Well, I
sloppy
mean,
work on my part. But interpret that for
Well,
us?
it's both, really. I mean, with nominal GDP, you've got that inflation and real output component to it, so it's all part of it. Um, no, I mean, I think you're right. I think it's just a, you know, I think it was a wording issue. The level targeting, you can interpret that as price level, or you can interpret that as output level. Anyway, all right, cool.
Well, I think it's pretty clearly both. I mean, that's what you and I would teach. We're talking about real versus nominal, and how that impacts the price level. Did you talk um, briefly about what it means for there to be a price level target path? That's straight out of the quote there. So
Okay. So in terms of the price level target path, that is going to be, and I've got I think about that quote pulled up here now. Um, the idea here is, if the Fed is going to just say, okay, we're doing 2% and we're going to only deal with Treasury bills, then I think, and it's been shown, they can do a pretty decent job of hitting a 2% inflation target. But hitting a 2% inflation target in, say, 2009 or 2010 or 1929 or 1930 is not going to do much for your output and your employment. And if they have this dual mandate to stabilize both prices and employment, then yay, you've stabilized prices, but we still have a crisis on our hands. So you can't just say, hey, I dropped interest rates to zero and I did everything I could, up to you guys now, and with fiscal stimulus to do it. What Sumner is saying is that the Fed needs to go in and do what it did in 2008, 2009, buy mortgage-backed securities, buy long-term bonds. And this is the implication, I was saying earlier, okay, buy corporate bonds, buy stocks, buy whatever asset you need to do to inject liquidity into the system. Because with fiscal policy, the limit is going to be the debt. We, if you go by Reinhardt and Rogoff and their book This Time is Different and the paper that accompanied it, there is a level. There's a question of where that level is, but there is a level that a federal government can reach in terms of debt or paying interest on debt, to the point where the opportunity cost of servicing the debt is now getting in the way of, say, building roads, building schools, hiring policemen, doing all the things a government should be doing. And what Sumner then is saying is that, well, the 2% inflation, the Fed isn't chained by a debt limit. Congress or the president will eventually lose their stomach for debt in terms of the numbers, or people. What I mean by people here is, I guess I should say investors, people investing in the U.S. government, buying those bonds, may look at their 30-year Treasury bond and say, well, we've got 110% debt to GDP ratio. Are they actually going to pay it back in 10 years, or are they going to default? And then you have cases like Argentina, where bondholders suddenly run. We're not going to hold on to this anymore. It may very well be that our government is solvent, but people don't believe it is.
right.
And then we get into this whole bank run issue, which the Fed tries to deal with anyway. So one way the Fed can deal with this is they can be the ones to buy up the government debt. They can be the ones, through monetary stimulus, to enact trillions and trillions of dollars worth of liquidity and push that out, where Congress and the president may have trouble getting, a spending plan of $2 trillion out. How many times can they do that this year before people start to lose their stomach for it? So that, I think, is where Sumner is going, that the Federal Reserve has less of a limit in what it can do than the federal government.
Right. So is it the case that it's more powerful for the Federal Reserve to target levels than it is for them to be cutting rates? Sumner says, and this is, I think, not a precise number, but a bit of maybe hyperbole isn't quite the word, but says that a move to level targeting would be 10 times more powerful than cutting rates. Do you agree with that? And if so, kind of lay that argument out for us, why that'd be stronger.
I do agree with that, because we have the zero lower bound. You can only cut your interest rates so long. I think this goes to and again, Summers got a point on this, that there's a certain myopia in focusing so much on interest rates. Really what we want to focus on is we want to focus on GDP. We want to focus on inflation. The short-term interest rate is an intermediate target, and that intermediate target can fail. But again, targeting inflation rates, targeting GDP, it's hard. So you have to have something to kind of anchor yourself to. What Sumner's asking for is a certain amount of flexibility. And I think I think he is right in these times anyway. There should be a certain amount of flexibility the Federal Reserve has. We need to watch it. We need to see what they're doing, because some things may work, some things may not. I would like to see the Federal Reserve target monetary aggregates, specifically divisia monetary aggregates, but I have my own bias on that.
Sure.
And they may not, I think they tell a lot of the story, but they may not tell the entire story. They may not tell what's going on in unemployment. They may not tell what's going on in commercial paper interest, well, for that, but bond interest rates. They may not tell what's going on in stocks. So he's asking for a broader look and a broader approach than what we've traditionally had.
So if we go all the way back to the first time I had you on the podcast, we were talking about monetary policy rules, and you said something to the effect of rules are great, except you need the leeway to react differently when you get into a crisis situation, to which I somewhat glibly said, that's like not following a rule at all. And so I think maybe you and Sumner are somewhat on the same page here, where a monetary policy rule has a limitation in that it's targeting an interest rate, and that is going to have some limitation, and maybe that works great in small downturns and definitely during your recoveries. But what happens when we get into a situation where you have a pandemic abutted against a potentially large recession?
But rules work really well until they don't.
Which is your favorite phrase, works until it doesn't, right?
Yeah. I like the Taylor rule. I'm a huge fan. But in the case like right now, I think if you plug in the numbers for the Taylor rule, it's still going to give you, you should be at 1.52% for a federal funds rate. What the Taylor rule is going to miss in this case is the fact that we have a global pandemic. That's not in the equation. You've got there's your inflation rate, there's your GDP. There's nothing about hospitalization rates or infection rates. It's a nice simple rule, but it may not capture everything that's going on, and that's where discretion can be a very powerful tool for central bankers. But discretion, much like rules, works really well until it doesn't.
So I want to turn now. We've talked about the targeting levels. We've talked about the interest rate a lot. What are some other things you think the Fed could do to stimulate the economy once the public health crisis is over? Because we've talked about essentially what the Fed is doing is laying the groundwork for recovery more than they are stemming the tide.
Yeah. So and that's going to be the role that they face. It's not so much that the Fed. I mean, the COVID-19 doesn't care what your overnight lending rate is. Lower interest rates do not disinfect hospitals. So what the Fed can do, they've already brought up a lot of the stuff, at least that I can think of, in terms of corporate bonds, commercial paper, negative interest on excess reserves. One thing that has been floating around, and I think is really interesting, the Fed is sort of this quasi-government institution, right? It's a private bank, but it's not really private. But one thing it could do is expand lending. Sorry, excuse me, let me clarify. The Fed can lend to small businesses, which is something that I don't think it does that much of right now. One, for lack of a better term, heterodox idea is to have the Federal Reserve step in as not just a central bank, but as a commercial bank. Now, there's a lot of landmines with that, and there's a lot of people who would, very much disagree with that. But that is, I would say 20 years ago, if I was to tell people, the Fed is going to be buying corporate bonds, they'd be telling me I'm crazy. Or if I told someone 20 years ago that they were going to charge negative interest on excess reserves, they'd tell me I was crazy. So one thing that the Fed could do, since we have this issue with the transmission mechanism of banks maybe not wanting to lend, or it might be the other end, maybe people just aren't wanting to borrow from those banks, maybe the Fed can make a few kind of lenient loans to small businesses through, say, their branches. Dallas Fed could go in and say, well, we have this problem with COVID-19 in the Dallas area. We can lend to delivery services, hospitals, medical services, get them that liquidity to, say, purchase ventilators, although we have a supply side issue there. But let's say the ventilators are there, they just need the money for it. Okay. They do direct lending. And again, I'm still on the fence on this idea too. I'm just kind of thinking about it. I know that the Dallas Fed, for example, does a lot of already does a lot of community work, and in terms of education and outreach, and getting, they're very involved in their district. But I'm not certain they're that involved with lending. But the Fed could very much just skip the transmission mechanism and lend directly to firms.
So does it concern you then, the size and reach of the Fed as they begin to accumulate more and more tools? It- I think the Fed has a good track record doing what they're doing, but what they've done in the
Mhm.
past is somewhat limited. And I think as you build a system that is more and more reliant on the Fed having impact at every level as directly as they can have it, that you potentially run afoul of some other problems. And so this is one of those things where I think in an ideal world, you'd like to see the Fed take the steps that they need to take in that situation, and then maybe not aggressively, but consistently back off of those kind of things. Like there was always some concern in certain parts of the world of economics about the rate at which the Fed was getting things off its balance sheet. This
Mhm.
rings the same to me, that I
Yeah.
would have some concern that, okay, they're going to get more involved in the shadow banking. They're going to get some stocks, some corporate bonds. They're going to go and they're going to lend directly to people in Dallas, and all of a sudden we're moving away from a
Right.
market
Mhm.
solution. And I get that, and I'm the first to understand and recognize that systemic risk and the inherent instability of financial markets is really important to account for. But I think as economists, we should also be recognizing that we want
Mhm.
market and price based solutions, and the Fed forever injecting liquidity in gives me some serious pause. Am I out in
No,
left
no,
field
I don't
here,
think you're
or
out
are
in
you
left
on the
field
same
here at
page with
all.
me?
I would say, first of all, the Fed needs to be audited. There needs to be an almost, yeah, there needs to be a complete transparency of what the Fed is doing, how they're doing it, what is on the books, what is off the books. And the Fed has made remarkable jumps since the early days, quote unquote early days, I guess, 50s, 60s, 70s, where no one knew what was going on inside. Um, and I attribute a lot of that to what Bernanke did in his term as chair, which I think was fantastic, was that he made a lot more open and available. I think a lot more could be made open and available, but it was a step in the right direction. What's been going on since the 1980s is a consistent decrease in interest rates. And if you look at the data, as we have this consistent decrease in interest rates, whether you're looking at 10-year bonds, 30-year bonds, mortgage rates, credit card rates, federal funds rate, they've all been on a downward trend since the early 80s. And one problem with that is that associated with this downward trend has been the increased concentration of financial assets to a very few financial entities. Bank of America has been getting bigger and bigger and bigger every year, along with Citibank, Wells Fargo, Goldman Sachs. Lehman Brothers was until 2008. This increased concentration could potentially lead to some monopolistic, say, behavior. Now, this is something that you and I have discussed with the Econ Club, where we
Well,
have,
let me interject.
where's the high prices? If Walmart has really taken up so much of the market, how come we now have more people purchasing more things at cheaper prices? If Bank of America has really taken up so much of the market, how come we have more people with bank accounts and lending rates that, compared to the 70s and 80s, are extremely low? What we may be moving towards with that kind of behavior is just a further and further increase of concentration of the financial markets to a few players, which does give me concern, because I'd like to see more financial firms out there, more banks out there. We've got in Amarillo, and this was something I really liked when we moved to Amarillo, Happy State Bank, Amarillo National Bank, First Bank Southwest, which are these middle to large size banks. I was living in Memphis and Dallas and Kansas City before, and everywhere you go, you see Chase, you see Bank of America. And it was kind of nice to see a very local banking system here in this region. But I'm not sure people from Amarillo know how unique that is, at least to
No,
what I've
I
seen
doubt we
here.
do.
But we're getting bigger and bigger banks, and these bigger and bigger banks could potentially take more and more risk. And it is possible that as the Fed does this, as they buy stocks and corporate bonds, as they lend more directly, they're taking on more systemic risk in the same way that Lehman Brothers did. And that does concern me.
Let me
Yeah.
go back. Yeah, actually, this is right on topic here. Let me go back a little bit because you mentioned concentration a
Mm-hmm.
couple times, and I want to make another point here because we've tied this in a couple of times, and I think it's worth repeating. It your financial system is different than other markets, right? And Arnold Kling makes the point that they hold the opposite asset and liability profiles from the rest of
Mm-hmm.
businesses by necessity. That's where they're holding they're holding these long-term assets that are illiquid, and they have these very short-term liabilities, and that makes them very susceptible to swings. And concentration makes that worse. And this is in part because of, you've mentioned, like overnight repurchases and things like this. When the financial system is very concentrated and very connected, it makes us at risk for systemic failure. And so we have a unique problem where concentration in something like airlines or car manufacturing or something like that puts us at risk of normal monopoly kind of powers, but there's not systemic risk in the sense that if GM fails, then Ford's going down tomorrow. Whereas if Lehman Brothers fails, then we're worried about Goldman Sachs and AIG and so on. And so, your plea to reduce concentration is not just for your typical monopoly consumer considerations, but also very much about the entirety of the system itself. And as painful as it would be maybe for Happy State or Amarillo National Bank to go down, if you have a world full of those in every different region, you have a very different kind of potential financial crisis than you do
Mm-hmm.
if we're worried about Chase or this level of firm going down. So comments about that
No,
before I
I think
move
that's
forward?
right. Each financial markets were designed to basically take future value and turn it into present value. I mean, it's to put it in cool terms, it's a time machine. You're trying to unlock
Yeah,
that
seriously.
future income or future return into present day spending, which can be really, really useful. People can buy houses which are extremely expensive based on the income stream that they'll be getting over the next 10 years. So in the meantime, they have a house and they're paying it off, and that's wonderful. You can do this with oil refineries. Of course, they need to, you need to pull the oil out. You need to refine it. You need to package it and send it out. And then you can obviously tell I know a lot about oil, right? But you know what I mean. It's a very, very large project that's going to take many, many years, and it's going to be really expensive. And you cannot do that without finance. So whether it is this kind of regional patchwork of competitive financial firms, or a concentrated financial firm, or heck, maybe even a nationalized financial firm, then the idea is supposed to be the same. How it gets done and the risks inherent in each of those structures are very different. We had a financial patchwork in the 50s and 60s, and there were instability issues with that as well. The 80s and the 90s, into the aughts, we see this larger concentration. On one hand, we had the Great Moderation, right, at the same time, which was nice. We had this very stable growth and this very stable financial system. On the other hand, 2001, for example, was a terrifying year and extremely traumatic. And growth and employment, it was. I think in the first podcast I referred to the what some economists are calling the beautiful V shape of a recession. It goes down and bounces right back up. But then, for something that traumatic and huge, financial markets bounce back nicely. But then we have 2008, 2009, where so much interconnectivity and systemic risk came to the forefront that there was, for lack of a better term, this huge run and this huge move away from this present consumption into a whole lot of savings and concern over future income. There is a certain weakness in that. And I believe that we are, even without COVID-19, in a period of contraction where people are rethinking future income. I think COVID-19 has made it worse, significantly worse. But I think, you and I in an alternate dimension without, coronavirus would be discussing this economic slowdown that we're seeing based on a stock market crash or a housing bubble or a different kind of asset bubble. I think this just was the needle that popped the balloon.
So is this crisis different than 2008? Is it only different because of coronavirus, or is there something fundamentally different about it? I think we're all sort of aware this is not just 2008 redo.
Yeah. Well, Ben Bernanke would say it's very different. And he has in his CNBC interview, he was talking about, he does think this will be a large dip, but it will be short. And when the recovery comes back, the Federal Reserve has positioned itself in such a way that it will be a good recovery. I disagree with that, because I think that it is different in terms of, yes, there's a global pandemic, and so there will be supply chain effects. But I believe that this will, and I think we discussed this a bit in the first podcast, this will change the way that consumers behave in such a way that will unleash a certain amount of creative destruction. Growth rates will recover, but probably not the way that economists want them to. I think we're, after this, I can definitely see another 5 to 10 years of slow recovery. That would be my prediction, because I think that there are certain aspects of where we are right now in terms of housing and stock market prices that we're overvalued. At least we were at the beginning of March. I don't know about now. After I haven't checked the stock market today, we may be undervalued by this point.
I'm really curious, because I think in 2008 we saw something specific related to the real estate market, and then the consequences of the behaviors of financial institutions. I don't get that either of those two things as a particular flavor of this recession. Of course, we're focused on the short-term effect that is the ubiquity of the damage that COVID-19 is doing to a wide array of businesses. I think in our daily lives, we always think about, travel and food. So we're thinking about the airline industries and groceries and restaurants. And groceries are probably going to be okay coming out of this. They're doing a lot of business right now, and obviously healthcare as well. That's an obvious thing, but then there are many industries that are potentially affected. You mentioned the supply chain thing. That's something you and I talked about a lot in that first episode. And yet I think Bernanke's point is as likely to be this would have been a different recession anyways, right? So we're kind of obviously filtering everything through the lens of the coronavirus. Do you have a sense of what those components might be? Would we still be sitting here saying this crisis is very different from 2008 in a world without coronavirus?
I would have guessed a second housing crisis, and I would
Really?
have guessed the stock market crash, and then a second housing crisis. The reasoning behind that is of course the issue with the yield spread inverting, showing some softness in the market and signaling some overpricing in terms of assets like stocks, housing bubbles. The needle that at least before coronavirus that I was kind of thinking actually was, and I think this is where I'm going to get thrown out and my PhD revoked and everything. I would actually say that there would be a potential crisis in exchange traded funds. I think that ETFs have been looking very, very stable for a very long time. I think a lot of people have moved a lot of money into them. And I think that those are extremely overpriced right now, and they are ripe for a run. Now, I'm not the only one on this. Michael Burry, who was, he got famous because Batman played him in The Big Short. Christian Bale played the guy in The Big Short. Yeah. He was one of the people that recognized that the asset-backed security markets, the mortgage-backed security markets, were overpriced, and there were some systemic risk issues. He has been writing several articles since 2019 about why exchange-traded funds have systemic risk that people aren't recognizing.
So for the listeners at home, tell us what exchange-traded fund is.
Well, it's in its most basic form, you kind of buy the entire you buy an index fund, right? Or you buy an entire market in ways. Your portfolio is based on whether or not the S&P 500 goes up in its entirety or the Dow goes up in its entirety. I'm horribly simplifying it, and feel free to flame me in the comments section on that. But what it does is it provided a really, really nice way for people to get returns from the stock market without spending a lot of time trying to figure out which stocks to buy and which markets to get into. And it's just kind of you buy this overall thing. But it does kind of look like an asset-backed security where you splice up a lot of small things, put it into one big thing. But there is a systemic risk in all these little things being sliced and diced and then recreated into a different index. That would be, in our alternate dimension where I would see the crisis coming.
So this is, and I think I've said this before, maybe in more than one podcast episode, this has always been my investment strategy. Buy the market, buy a large fund, stick your money in there and leave it be. And so I can actually see there's an intuition there, which is people are overly confident in those kind of funds, and so they put more, they buy more, they build those up, higher, and there's your bubble right there. And so it is not apparent to me exactly how that mechanism would work. I'm not going to go and immediately divest myself from everything based on this being a potential bubble, but I can see the intuition there. And I think that's one of the things. If I can borrow your line, everything works until it doesn't, right? And maybe that's the thing that is working now, but may not in the short term or in the near term.
Yeah. Although I don't know, I'm out in the wilderness on that one. So that.
Yeah, that's what you meant when you said you're gonna have your economist card revoked and get your PhD taken away, saying blasphemy.
Yeah, I'm blaspheming against
large
market here. Yeah.
So we're over an hour now, so I want to bring this in for a landing, and I think we're set up perfectly for one last question, and that is, given that the Fed has laid the groundwork for a monetary stimulus and for a recovery, what should the listeners be looking for? What measures should they be watching to see if the stimulus is working?
So the usual stuff you should always be watching. Look at the employment figures, GDP. I would add, I think that people should be looking at the Divisia measures, because what the CFS and Bill Barnett have provided are a wealth of information, and you're going to see whether or not we have a healthy financial system that's continuing to grow or if it's going to contract. If the stimulus is working, I would see the division monetary measures as continuing to grow, somewhere between 2 and 4% or 2 and 5%. If the stimulus is not working, they're going to go negative. They're going to go below zero. You'll see a contraction in the money supply. I would look at excess reserves. If excess reserves climb back up to 2-3 trillion, we're not getting that lending. That transmission mechanism is still not working. So there's still a weakness or a softness within the economy. The employment figures, like I said, those work really well until they don't, because we had gangbuster employment figures right up until 2 weeks ago. And that's, everyone talks about, we had this record unemployment figure and it's been so low. Those unemployment figures can change really, really fast. So yes, keep an eye on unemployment, but keep in mind that can change very quickly. Keep an eye on the inflation rate. Are we near the 2% target that the Fed wants? GDP, of course, are we near that 2% potential output, or 2%-ish potential output that we should be seeing? But every middle of the month, I open up the CFS website and I look at the division measures. And if they're growing faster, then, okay, that says to me we've got some monetary stimulus action. If they're at a nice, stable 3-4%, then things are chugging along. If those fall below zero, then we're in trouble. And that's what I would say in terms of figuring out whether or not the stimulus is working. The monetary stimulus, anyway.
My guest today has been Ryan Mattson. Ryan, thank you for joining us on the Econ Buff.
Thank you very much, Lee. I appreciate it.
Thank you for listening to this episode of the Econ Buff. You can find all previous episodes on YouTube at Econ Buff Podcast. You can check out our website at econbuffpodcast.wixsite.com. That's WIXSIT.com. You can contact us at econbuffpodcast@yahoo.com.